The global financial system operates on a foundation that most people don't understand, and many policymakers struggle to monitor effectively. A $700 trillion derivatives market, with actual net credit exposure of $237 billion after netting and collateral, sits at the heart of modern finance, determining interest rates, shaping government borrowing costs, influencing corporate survival, and deciding whether pension funds can meet future obligations. This market is not peripheral. It is the skeletal structure of global finance, silently directing how money flows through banks, corporations, and nations. What makes this system particularly dangerous is not just its size, but its extreme concentration. Four major American institutions, JP Chase, Citibank, Bank of America, and Goldman Sachs, control 88.1% of all derivatives held by U.S. banks. These institutions depend on these instruments to function, using derivatives to manage everything from interest rate exposure to currency risk. A single move in rates or currency valuations can cause billions in gains or wipe out tens of billions in losses instantly, because the underlying positions, while heavily netted and collateralized, still represent enormous gross exposures measured in tens of trillions. Governments also rely on this structure. Their bonds, refinancing cycles, and borrowing costs are all influenced by derivative pricing. When a country issues debt, the interest it pays is often hedged, swapped, or insured through these contracts. If derivatives malfunction, global sovereign borrowing becomes unstable. The interest rate a nation pays on its debt, 5%, 8%, 12%, can spike suddenly because the derivative cushion supporting it destabilizes. This is why a disruption in this system doesn't stay isolated on Wall Street. It hits national budgets, social programs, and public wages. Corporations depend on derivatives for managing risks they cannot control directly: fuel costs, currency fluctuations, commodity volatility, foreign sales exposure. Airlines, shipping companies, manufacturers, tech firms, food processors, and even hospitals use them. Without functioning derivatives, companies cannot plan future costs, guarantee prices, or maintain payroll and debt service. The moment the derivative market freezes, the operational system of corporate America freezes with it. This hidden network also determines the safety of the world's $58.5 trillion in pension funds. Their long-term liabilities are hedged through interest rate swaps and complex derivatives engineered to match future payouts. As the IMF documented in 2025, the world's largest pension funds have significantly increased their allocations to derivatives and other forms of leverage. If these hedges fail during a crisis, pension systems instantly destabilize. This is the reality beneath global finance. The actual risk exists in interconnected derivative obligations that bind nations, banks, corporations, and households into a single fragile structure. To understand the magnitude of the threat, you must understand what derivatives actually represent and how their risk is measured. At their core, derivatives are financial contracts whose value is tied to something else: interest rates, corporate debt, government bonds, currencies, commodities, or equity indexes. They are not tangible assets, but mathematical agreements, pricing formulas, and leveraged obligations written between counterparties. The notional value, the headline number, represents the scale of the underlying exposure. A bank can control a $100 million interest rate swap by posting as little as $1 million in margin, creating 1-0-0-to-1 leverage. A 1% move in the underlying asset can erase the entire collateral base. However, the notional value is not the money actually at risk. After accounting for legally enforceable netting agreements, the gross market value of all OTC derivatives globally is approximately $17.1 trillion. The replacement cost if all contracts needed to be closed today. More importantly, net current credit exposure, which accounts for both netting and collateral, stood at just $237 billion for U.S. banks in the third quarter of 2024. This distinction is critical. While $700 trillion sounds catastrophic, the actual at-risk exposure after netting is approximately 0.04% of that notional amount. Netting agreements allow banks to offset positions, reducing gross exposure by 88%. Collateralization further protects against losses, with $389.8 billion in initial margin posted at central clearinghouses by the end of 2024, plus an additional $1.5 trillion in margin for non-cleared derivatives. However, these protections have limits. Netting only works if counterparties remain solvent. In a simultaneous multi-bank failure, these offsets can evaporate, converting net exposure back toward gross exposure almost instantly. Collateral must be liquidated quickly in stressed markets, potentially at fire sale prices. The reliance on models and assumptions about correlation makes the system vulnerable to unexpected shocks that models didn't anticipate. The explosive scale of today's derivative market did not appear overnight. It emerged from decades of deregulation, financial engineering, and institutional dependence. The turning point began in the late 1982 when global financial markets embraced new models allowing institutions to transfer risk off their balance sheets without removing underlying liabilities. By the early 2000s, derivative volumes were growing at double-digit annual rates, fueled by investment banks competing to engineer increasingly complex products. The International Swaps and Derivatives Association agreements provided standardized legal frameworks, enabling banks to write massive contracts without extensive public scrutiny. What was once a tool for hedging became a profitable engine for leveraged speculation. The globalization of finance further magnified this growth. By 2007, the notional value had climbed above $500 trillion, largely unseen by the general public because most contracts were traded privately in over-the-counter markets rather than on regulated exchanges. The financial crisis of 2008 exposed the consequences. When mortgage-linked derivatives imploded, the entire system nearly collapsed. Instead of dismantling or restructuring this architecture, policymakers implemented reforms but kept the basic structure intact. Central banks slashed rates to zero, creating an environment where interest rate derivatives multiplied. Debt issuance increased sharply, and institutions used swaps and options to manage expanding obligations. The market rebounded and exceeded pre-crisis levels within years. Today's $700 trillion market is the cumulative result of financial dependence on leverage, risk transfer, and interconnectedness. The near collapse in 2008 was not caused by mortgages alone. The true detonator was the derivative structure built on top of those mortgages. When banks packaged mortgages into securities, they stacked derivative contracts on top, multiplying exposures from billions into tens of trillions. Lehman Brothers embodied this vulnerability. On paper, Lehman reported assets of $639 billion and liabilities of $613 billion, appearing marginally solvent. Hidden beneath those filings was $35 trillion in notional derivative exposure, 906,000 contracts dependent on the performance of deteriorating assets. When housing prices fell, counterparties demanded additional collateral. Lehman could not meet those demands, and once confidence evaporated, the institution collapsed. That collapse was not contained. Every derivative contract connected to Lehman became immediately unstable, exposing institutions across Europe, Asia, and the United States to unanticipated losses. However, it's important to note that Lehman's derivatives were ultimately resolved more smoothly than many predicted. LCH SwapClear managed $9 trillion in interest rate swaps within 3 weeks, using only 35% of posted initial margin. This demonstrated that central clearing infrastructure could handle even catastrophic failures, though whether it could manage simultaneous failures of multiple large institutions remains untested. AIG revealed the second dimension of the crisis, having sold approximately $500 billion in credit protection through credit default swaps without holding sufficient capital to honor potential payouts. The U.S. government ultimately provided $180 billion in emergency support to prevent the collapse of institutions that depended on AIG's derivative guarantees. The coordinated global response involved an estimated $29 trillion in total commitments when measuring all Federal Reserve lending facilities, asset purchases, guarantees, and international coordination, though this figure includes loans rolled over multiple times. Peak outstanding loans reached approximately $1 trillion in late 2008, with TARP disbursing $443.5 billion. This intervention was unprecedented and barely sufficient for a derivatives market that was 1/10 the size of today's. The structure of today's derivatives market carries different but significant risks compared to 2008. The total notional exposure has expanded from roughly $60 trillion to over $700 trillion, but the composition and regulatory framework have evolved. Post-crisis reforms mandated central clearing for standardized derivatives, moving 60 to 70% of the market to clearinghouses with daily margin requirements. This reduces but does not eliminate systemic risk. Interest rate derivatives exceed $579 trillion globally, representing the largest concentration of financial exposure ever recorded. These contracts rely on assumptions of rate stability, yet rates have undergone their most violent swings in 4 decades, from near zero in 2021 to over 5% by 2023. Every increase created substantial winners and devastating losers. Institutions anchored to fixed-rate assumptions carry mark-to-market losses that remain hidden by accounting exemptions, masking vulnerabilities that could surface abruptly under renewed volatility. Credit derivatives totaling $9.2 trillion reflect a world where corporate and sovereign debt have reached historic heights. Corporate liabilities in the United States alone expanded from $2 trillion in 2008 to over $10 trillion by 2025. Higher refinancing costs make defaults more likely, and each default triggers derivative obligations that counterparties may be unprepared to honor. Currency derivatives exceeding $130 trillion face pressure from geopolitical fragmentation and weakening confidence in the US dollar as the dominant reserve currency. As more countries diversify trade settlements away from the dollar, foreign exchange markets experience sharper dislocations. Derivatives tied to these movements can shift billions in value rapidly, creating stress across banks that assumed stable monetary hierarchy. The core instability becomes unmistakable when examining concentration. In the United States, 4 institutions, JP Chase, Citibank, Bank of America, and Goldman Sachs, hold nearly 90% of all derivative exposure. JP Chase maintains the largest exposure with approximately $54 trillion in notional derivatives, supported by around $300 billion in capital. Citibank holds roughly $48 trillion with capital near $200 billion. Bank of America carries close to $37 trillion against approximately $280 billion in capital. Goldman Sachs holds an estimated $47 trillion in derivatives, nearly 30 times its equity base. While netting and collateral reduce actual exposure significantly, these protections depend on stable markets and reliable counterparties conditions that evaporate under stress. When volatility spikes and credit risk increases, offsets fail, liquidity disappears, and gross exposure becomes more relevant. The interdependence among these banks intensifies the danger. They often hedge with each other, creating circular exposure loops where one bank's hedge is another's liability. If one institution loses solvency, the others face instantaneous revaluation shocks. The vulnerability created by this concentrated derivative structure becomes far more dangerous when examined alongside emerging catalysts. Interest rate volatility remains the most immediate pressure point, with over $579 trillion in contracts tied to rate movements experiencing the fastest adjustments in over 40 years. Commercial real estate presents another destabilizing force, with over $2 trillion in mortgages requiring refinancing at sharply higher rates, creating a default wave that will impact credit derivatives directly. European banking instability adds a global dimension. Deutsche Bank, with exposure exceeding $40 trillion in derivatives, faces persistent market concerns. A failure within Europe would immediately transmit losses to US institutions through interconnected swap and credit positions. Sovereign debt vulnerabilities in Japan, with debt exceeding 260% of GDP, and China's property crisis compound these risks. The most alarming reality is not simply the system's size, but the challenge of stabilizing it once instability begins. In 2008, governments and central banks coordinated an unprecedented intervention. That rescue was only achievable because global debt levels were lower, political support existed, and financial systems retained credibility. None of those conditions exist as favorably today. Government debt across advanced economies has soared. The United States carries over $38 trillion in federal liabilities with annual interest expenses, approaching levels that exceed major national programs. Europe faces similar burden ratios. A bailout requires governments to issue new debt, but markets cannot absorb trillions of fresh bonds without destabilizing yields. Central banks have already expanded their balance sheets to unprecedented scale. The Federal Reserve grew from $800 billion before the last crisis to nearly $9 trillion after pandemic-era interventions. Injecting new liquidity at the scale potentially required to stabilize a failing derivative system would risk uncontrollable inflation. The price shock of 2021 to 2023 demonstrated that even modest liquidity oversupply can destabilize economies. Political constraints intensify the problem. After years of rising inequality and public frustration with financial institutions, there is minimal support for another Wall Street-centered rescue. Without political authorization, central banks cannot deploy unlimited emergency facilities even in a systemic event. The structural challenge is more severe. Derivatives are not assets that can be purchased or stabilized. They are bilateral contracts where one party loses and another wins. Every path to stabilizing a failing derivative system leads to outcomes that carry significant costs, currency devaluation, sovereign instability, or political paralysis. When a system built on $700 trillion in interconnected obligations with $237 billion in net credit exposure begins to fail, the breakdown occurs faster than traditional financial crises. Once a major counterparty cannot meet derivative obligations, every contract feeds directly into another institution's balance sheet. The first stage begins with sudden inability to post collateral. A single large bank fails to meet a margin call triggered by rate movements, credit events, or currency shocks. Counterparties are forced to revalue their exposures, revealing losses hidden by internal models. Liquidity evaporates next as banks that normally lend to each other halt unsecured transactions. Clearinghouses face strain as margin shortfalls accumulate faster than they can absorb. Payment systems begin to fail as large transfers are delayed or rejected. By the time the crisis reaches full scale, supply chains seize as companies lose access to operating capital, and governments face emergency funding shortages as bond markets demand higher yields. Modern finance was constructed on the assumption that counterparties would always perform, liquidity would always be available, and central banks would always have tools to restore order. A derivatives crisis tests all three assumptions simultaneously. The system that required historic intervention when it was 1/10 its current size now operates with less fiscal and monetary capacity to respond. The danger is not hypothetical, it is structural, mathematical, and increasingly probable as multiple stress points converge. The question is not whether the system faces risk, but whether the protections in place, netting, collateral, clearinghouses, can withstand simultaneous shocks that exceed their tested limits.